Well, when we launched the funds at outset just over a year ago, that was in January 2015, we'd had a period of uncertainty just before we launched in the fourth quarter of 2014, and we felt that might continue. And we were perhaps a little cautious in getting too much risk asset into the portfolio because our outlook was a little bit defensive and a bit too cautious. And markets had a good run in the first quarter, and we did get a little bit left behind. Our focus of risk assets has probably been throughout biased towards east versus west. So we've been pretty defensive because we've been for some while feeling that central banks would lose control of asset prices or supporting asset prices, and that there are too many problems out there from a macro point of view. And global growth is on the decline still. We get all these government hopes that GDP numbers are going to pick up, but virtually every revised number is downwards, and that's unfortunately the way it's going. So slow growth, low interest rates, disinflation, deflation even maybe, and probably I wouldn't be surprised. It wouldn't take a lot to see one or two areas of the global economy move into recession. And so that's a bit gloomier than a lot of other people are suggesting. So we don't think we're out the woods on that one yet. So we positioned ourselves reasonably defensively. We did too early move into some protection with gold around middle of last year, which didn't initially do us much good, but has helped us immensely with the more volatile times recently. We positioned ourselves within the funds certainly on balanced and opportunities at the riskier end to hold quite a reasonable chunk of assets in non-sterling. So we've had up to half in mainly dollars and some yen assets there, which has done us particularly well as sterling has weakened. Volatility creates opportunity. It creates crises and panics and things like that. Things sell off that probably shouldn't, or you do get babies in bathwaters situations, particularly with ETFs. ETFs change the world quite a lot in terms of how people react. So they sell a market. Well, a market's got good stocks and bad stocks in it. They sell an index. They sell a pile of something or other. So, and it gives the active fund managers who have had a difficult time over the last few years more opportunity to actually exercise their views of life, because we're principally fund to fund. Open and closed end sector, so the good fund managers, it gives them more opportunity as well. So it works well through. So opportunity. It brings a smile on our face when we see things getting oversold. If anybody thinks that Europe's suddenly going to ban our exports into the UK's exports into Europe's got another thing coming. Europe exports far more to the UK than we export to them. They're going to keep those flows going. Nothing's going to change that I can see of, or not materially anyway. It doesn't seem that anybody's really taking control of the destiny of the European Union. The euro has always been a huge mistake. You can't have a currency union that's going to work properly without fiscal and political union with it, and it's the wrong way round. It should have come third. Is there a chance of that really happening? I don't know. There were some people who would say, and have said, that the UK is better to get out of Europe before it implodes anyway. That's probably a little bit aggressive. I'm not sure that it implodes, because it will probably exist in some form, but it doesn't seem to be developing or going anywhere at the moment. In fact, almost going backwards. They can't seem to agree on anything. The shambles over borders and Schengen and all that's been going on with the Syrian crisis and refugees. Totally focused on the multi-asset side of things. In other words, what we were doing at Maitan in Reading. So totally focused on that. We'd like to launch more funds. We've got 3 at the moment, as I say, defensive, balance and opportunities. We would like to launch an income fund, and we've got other ideas as well.
Such as?
Well, I think there are opportunities in 1 or 2 individual sectors, like potentially running a low volatility, more defensive style of real estate or resources potentially, but that's some way down the line. Would like to launch an investment trust as well. That's been on a radar for a long time and has just nearly got off the ground a couple of times in the past. but we'd certainly like to do that on a closed-end fund on a macro basis. But these are things that are for 2017 and beyond, not for today. The regulatory issues that have changed in recent years, our marketplace is the advisor and wealth manager marketplace, totally 100%. We do not work with the institutions. We're totally in that marketplace. And that's a very difficult marketplace because they've been forced to go down rating agency routes rather than selecting their own funds on their own knowledge. They've been forced to use more platforms. You've got to get on all the platforms, which is quite hard work. We've successfully achieved that. The rating agencies have been harder. So we're behind what we expected for last year, but the good news is this volatility in markets has seen a sudden real uptick in interest and flows over the last few months. So that's been nice and refreshing when we were getting a little bit nervous about what people perhaps were thinking of a new set-up business. So that's been very good. So along with the market volatility, etc., it's been a happy place this year. Got particularly noticed at Miton because in 2008, both strategic and special situations both had positive returns during that year. And again, there were very few funds. I think it was about half a dozen in total that actually had positive returns in the managed sectors. So, but there have been other good periods as well, and along the way, plenty of disappointing periods where we've just been out of kilter and away from what's been going on. There's nothing better. I look forward to my Saturday mornings, sat at my desk at home, with the week's FTs, what I haven't read of them, which is often quite a lot of it, any other research material that I've stacked up. And sometimes I'm catching up with research material and things that I wanted to read that are 3 or 4 months out of date, but it doesn't matter because the detail's still there, the interest is still there. These things don't change overnight. It's not our style. So there's a lot of reading done, not just by me, but and we discuss a lot of those things. So we've always formed our own views. I am not interested in a Fidelity or a Goldman Sachs' views on the market. It's tempered to what they're doing. My style has always been buy early, sell early. Don't try to pick bottoms and tops. You're crazy if you do, because you'll get that. Set targets as to where you think you're going to get really interested in something. Be patient, and then be patient, and then be patient. Bide your time. Don't have to make a decision on the spur of a moment. Best decisions are always slept on, generally. Occasionally, it's worth making a quick snap decision, but very rarely.
You still loving it?
Absolutely, I live and breathe the market, so it's fantastic. It's not obsessed by it, but on the other hand, I just love what's going on there. So it's leisure to me, as I said. Sitting and reading an FT with a pot of tea and then another one over weekends is particularly in the summer when you can sit outside. I've got a lovely garden, lovely views over Lyme Bay. So how lucky am I?